There is very little doubt in anybody's mind that this particular tightening cycle, whether we look at our Fed or central banks around the world, is totally unique in every way. We are pulling back from the types of liquidity we've never put forth. Do you agree with that, Vincent?
Oh, that's no question about it. Central banks dipped deep into the toolkit of unconventional policy, and what they found was it was easier to start them than it was to end them. The Fed, at least, is in the motion, shrinking its balance sheet. It is motion with its policy rates. It is going to take the ECB another year and the Bank of Japan even longer after that. But they've got a long way to go.
Now, I don't mean this as an insult to investors, but I personally think over the years investors have gotten a bit lazy. The central banks around the world have been leading investors to make sure, in their opinions, that the liquidity helps alleviate some of the post-crisis ills. But now we have all these static comparisons. Everybody points to the Fed fund futures and said, this is going to happen in 2019, this may happen in 2020. I think we need to be more dynamic in our approach. What do you think?
Oh, I think that's right. I think Chair Jay Powell understands that and is going to be holding investors' hands less tightly going forward, getting out of some of that guidance game. But, think about it. We've been around long enough to remember when the first Fridays of the month was exciting because the employment report really mattered to what the Fed would be doing in its next meeting. The fact is, the last few of them have just been sad because there's no number that could have printed that would influence what the Fed's doing. Why? Because they feel compelled to tell us the meeting before what they're going to do at the next meeting, and they're on a cycle of tightening only once a quarter, i.e. tightening at most one percentage point a year. This is as measured a pace as we've ever had.
Vincent, do you think we need to get to what is eventually deemed as neutral to get to the type of symmetric Fed policy that we used to have in bygone days before computers ruled the world, where you had to stand up as an investor, survey the surroundings, and then decide what you think the Fed may or may not do? Do you think it would be healthy to break the addiction of liquidity and try to push investors into that role? That's
Jay Powell's real exit strategy. You inherited a communication strategy of a lot of guidance, of tightening a quarter point every quarter. Investors understand it. He's going to keep on doing it till he gets in the neighborhood of neutral. That's probably 1 percentage point or so from here. And at that point, he's going to stop and say, rates could either go up or they could go down or they could stay the same. It's about the economy. You can figure it out too. It's up to investors to come to their own view of what monetary policy should do. He's not going to tell you what they're going to do. I think that would be a nice world to live in. But the reality is that to get to that point, it's most likely going to create a lot of unease in the marketplace. It may show up as equity volatility. It may show up in a variety of articles that think the Fed is actually working against the economy. And in the final half minute here, what would you tell investors about how they should look at the economy and the Fed over the next couple of years? Jay Powell is on track. It works for him, so he's just going to do the quarter until it's time to stop. Once he stops, it's going to be investors' responsibility to figure out where rates are headed. He's not going to tell you where they're headed because he doesn't know where they're headed. We're going to have to do more due diligence in understanding the macro view and the risks the Fed are facing.